Hello, welcome again. This is John Flynn here from Flynn Real Estate, serving Southern Ontario. Here again to give you my honest and professional opinion about the 2022 Canadian housing market. So this week's been a busy one. The ship is sinking, plane is going down. Let's get right into the major events. We got Bank of Canada, we got Canadian Real Estate Association press release, and some other stuff. If you want to know what's going to save us, wait until the end, and I might have an idea. So as per CREA, the June release for the national statistics, Canadian home sales down again in June, but declines are getting smaller. Hey, wait, maybe the plane isn't going down. Maybe the ship isn't sinking after all. This seems like good news. The declines are getting smaller. Well, let's see what they have to say. Home sales fell by 5.6 on a month-over-month basis in June. Actual, not seasonally adjusted, monthly activity came in 23.9% below the June record set in 2021. The number of newly listed properties was up 4.1% month over month, and the MLS home price index edged down 1.9% month over month, but was still up 14.9% year over year. And the actual national sales price posted a 1.8% year over year decline in June. This one's big because this is the first month-over-month decline we've seen in a long time. So here are the national home sales that fell 5.6%, and it goes back to the title of this article, which says, they're down again in June, but declines are getting smaller. So I guess they're trying to keep a positive spin on the market here. It's probably about the only positive thing it's not made up, but it's been focused on. So you can see here, the decline is getting smaller than the 11 and 7 points, whatever it was before. So our sales are down, but they're down less than they were in the previous months, month over month. So I guess that's a good thing. It is a good thing, I guess, but probably not the most important thing of this release. It's probably the least important thing, but it made the title, right? So I just wanted to point that out, and let's look at the actual numbers. Here's the actual activity, down 23.87% from last June. And again, last June was a record setter, so take from that what you will. So here is the MLS price index, the composite index, which again is this made up index benchmark that is based on like a 15-year historical average. It's really hard to understand. I don't like it, but anyway, I like averages. So we're up 14.89% year over year on this index from June to June. But as I mentioned before, when you're looking at average prices, we're down again month over month, 5.87% from May to June, and 1.83% from June last year. So this is the first month over month decline we've seen in average, which is a big turning point in my opinion. And if you go back to the month over month from this year, the 5.87%, it actually works out to $41,500 for the national price, which is what, $10,000 a week, as previously stated in my last video. And if you're looking at from the peak, we're down 18.5% from the peak, which is $151,000 on average for the average price in Canada. The average house price, $150,000 it's dropped in Canada since the peak. I think this is a lot more relevant than year over year average, because it's old data. You're using old data. It's useless. We want to see what's happening now. What's happening now? We're down 150 grand. And our listings are up 4% month over month. More inventory. You guys want inventory? Don't build them. It's coming by itself. Back to the actual release. I took some key points away from it here. Sales were down in 3/4 of all local markets, led by Canada's biggest cities, Greater Toronto Area, Greater Vancouver, Calgary, Edmonton, Ottawa, and Hamilton, to name a few. And here's the 10-year moving average. If you remember from my last month's video, we were approaching or just at the 10-year monthly moving average line. We've now gone past it. So anyone that likes stock indicators or any sort of statistical analysis indicators, we have passed that. We were heading that way. It wasn't a big surprise, but we have passed the 10-year monthly moving average, and we're going to continue the downtrend, in my opinion. Here was an interesting point the economist made for CREA. One important feature of the market right now that isn't getting enough attention is the difference in mortgage qualification criteria between fixed and variable, because while variable rates adjust in real time, Fixed rates have already priced in most of what the Bank of Canada is expected to do over the balance of 2022, said Sean Cathcart, CREA's senior economist. As such, it's no surprise to see people piling into variable rate mortgages at record levels, but probably not for the reasons they may have chosen them in the past. It's because the 200 basis points plus the contract rate element of the stress test has, since April, just become much more difficult to pass if you want a fixed rate mortgage. A strict stress test made sense when rates were at a record low, but policymakers may want to assess if it continues to meet the policy objectives now that fixed mortgage rates are back to more normal levels. So I think the problem now will be people won't be able to qualify with the stress test for fixed rate mortgages. So that's why they're piling into these, and it's going to become an issue. With sales down and new listings up in June, the sales to new listings ratio eased back to 51.7%, its lowest level since January 2015. It was also below the long-term average for the national sales to new listings ratio of 55.1%. So again, pretty significant, lowest level since 2015, since January 2015, that we've had this sales to new listings ratio, and it's well below the all-time average. Regionally, most of the monthly declines were seen in markets in Ontario. Home prices have also eased in parts of British Columbia, although BC provincial totals have been propped up mostly by static prices in Greater Vancouver. Prices continue to be more or less flat across the prairies, while only now showing small signs of declines in Quebec. On the East Coast, prices are mostly continuing to rise, but appear to have stalled in Halifax, Dartmouth. So everywhere is affected at this point. Like I've said before, those other areas, they do lag behind us. So now they're starting to see those declines and obviously stalling in some areas. So now on to the big one from last week, the 1% interest rate hike. I thought this screenshot was kind of ironic, so I wanted to include it. And you see Tiff, and I forget her name down there with their smiles on. She's the deputy, whatever she is. And the quotes, we got to read the quotes. And this is right on the Bank of Canada site, on the homepage. We are Canada's central bank. We work to preserve the value of money by keeping inflation low and stable. And of course, you have the 2.5% interest rate, the inflation which they work to keep low at 7.7%, and a couple of smiling employees of the Bank of Canada that have failed miserably at their jobs. I wouldn't be smiling, and I wouldn't be putting these things on the same web page. Anyway, so on to Tiff Macklem's press release and some important points I wanted to point out. Things are not normal right now. After 30 years of low, stable inflation, many Canadians are experiencing the pain of high inflation and the uncertainty that comes with it for the first time. So Tiff is letting us know things are not normal, if you guys didn't know. Higher interest rates will slow demand and allow supply time to catch up. Consumer spending will moderate as the pent-up demand from the pandemic restrictions ease and the cost of borrowing increases. Housing market activity is already cooling rapidly from unsustainably high levels during the pandemic, and slower global growth will reduce demand for our exports. So you're going to be able to afford less because of higher interest rates and higher debt servicing costs, and he's confirmed the housing market is already cooling. While we may see a few more months with CPI inflation around 8%, we expect it to decline later this year, ease to about 3% by the end of next year, and return to 2% target by end of 2024. This is the soft landing we are projecting. Interest rate increases can cool demand and inflation. Everything looks like it's on track for the soft landing, guys. By 2024, we'll be back to 2%. We're going to see increased interest rates until then, but we're on track for that soft landing, as long as this works out the way it does. But the path to the soft landing has narrowed because elevated inflation is proving more persistent. And this requires stronger action now so consumers and businesses can be confident that inflation will return to the 2% target. Wait, I thought we were on the right path, but the path is narrowing. It doesn't give me a high level of confidence, that last statement. We continue to expect that interest rates will need to rise further to cool demand and achieve the inflation target. So more interest rate hikes, obviously. So how are these interest rates going to affect us? Or homeowners and in general, right? That's what I'm talking about here. So I put together just one scenario with the increase in rates just to show how it affects payments and whatnot. And this is based on variable rate mortgages. Now I get a lot of comments that say, well, I have a variable rate with a fixed payment, so my payment doesn't go up, right? So they obviously just change the amortization periods. So we're going to look at both scenarios. How will your payment change if your on a traditional variable rate mortgage where your payment changes when the interest rate changes, and how will it look if you're on a variable rate with a fixed payment, and that's not a traditional method, but your amortization will change. So let's look at both. So here you have a $400,000 mortgage. You have the rate of 1.3% back when it was that, January, February, or even before, and a 25-year amortization. You're paying $1,560 a month. The rates go up to 2.3%, and your payments $1,754. Now the payments are up to $1,960, so $400 more, and the rate's at 3.3%. And today, at today's rates, at 4.3, we're at $2,178. So your monthly payment has gone up over $600 from January or February, whenever it was, because of interest rate hikes. And that's a lot of money to some people. Other people are good income earners. It might not affect them too much, but it still hurts. It's still $600 less you have to spend every month, or save, or whatever you're going to do. Now let's look at keeping the same payment, but with the changing amortization. So $1,560 a month, 1.3%, 25 years. Rates go up to 2.3, keep your same monthly payment, and you're at 29 years, 4 months. So you got 4 years, 4 months added onto your mortgage. Not a big deal. They'll come back down one day, right? Now we're at 3.3. Now remember, we're past these rates. This is just the history here. At 3.3, now you're at 36 years, 11 months, almost 37 years to keep the same payment. I don't know if the bank is going to allow this, or if you're going to hit your trigger rate by now, but it's a pretty long amortization. And now we're at today's rates of 4.3%. I couldn't even fit the payment because it won't let me go past 50 years on this calculator. So you're about 53 to 55 years to keep the same payment of $1,560, whatever it was, at a 4.3. I don't see banks changing your amortization to 50 plus years without triggering your increased monthly payment. Now, if you guys can look through your contracts or let me know what that trigger is, usually it's 2.5%, and there's a trigger rate and there's a trigger point, which comes after the trigger rate. But there's not too much information on it out there, and it's sort of a new product. Yeah, let me know if you guys have any information on this, because I'd really love to know. Which brings me to my final discussion today. Johnson, as in Boris Johnson, ex-Boris Johnson, weighs 50-year mortgages that children can inherit. This was a couple of weeks ago, this article. Boris Johnson is exploring plans to offer British homeowners longer mortgages that can be passed between generations, the latest move by the government to stimulate housing demand. So in the UK, they're kicking this idea around, and of course they've always had high house prices over there, but they're kicking this idea around that you can just pass it on to your kids when you die, the mortgage. It's just like an investment now, right? You don't own your house, you just own half of it, and your kids get to take on the new mortgage. I don't know if they have to qualify. I don't know what the rules would be, but this is just an idea at this point. But these ideas come to fruition many times, especially when governments start talking about stuff. And down there in the fourth paragraph, I like this part. We want to find all sorts of creative ways to help people into ownership, Johnson told reporters on a trip to NATO. So creative ways to help them into ownership. I got a few, or at least a couple. We could sell an organ, a kidney, maybe both kidneys, and go on dialysis. I could sell my soul to the devil to get a mortgage. That seems like a creative way to do it. You actually have to come up with creative ways now so people can buy homes. When 10 years ago, 5 years ago, 20 years ago, you want a house, you get a job, you save up, and you pay for a house with a down payment. Now we're looking at leaving a 25-year mortgage to your kids when you die. So that's like a multi-generational mortgage. Do your kids have to qualify when you do? Or it's insane, right? But this is what their plans are, or this is what they're kicking around. Instead of raising interest rates to control markets and to control inflation, they're like, no, let's just make it intergenerational debt. That seems like a great solution. Anyway, thanks for watching again. Until next week, I'll see you then.